Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Wednesday, April the 3rd, and we have Brent crude oil trading at smack on $90 a barrel. Yesterday, when we were here at 10:30 UAE time, it was $89 a barrel. So there's a clear upward draft here in the oil markets. Kate Durian, Me's contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington, sitting in Dubai. Kate, what is the main driver of this oil price now? We've clearly broken out of the range we were stuck in for most of the first quarter. What's the main driver, do you think, moving us towards $90?
I think it's a combination of factors. It's rising geopolitical risk in the Middle East following the attack in Syria on an Iranian consulate or embassy complex, whatever it is. Continued attacks in the Red Sea, and I'm sure that my colleague from Kepler will give us the last numbers, but I think the magic number now has hit 100. Attacks on Ukraine by Ukraine on Russian refineries. Dollar, the expectations of interest rates staying as they are for the moment, without a cut. So I think it's just a combination of factors. There's so much uncertainty. It's really difficult to see sort of direction, but I think it had been expected. There was a bullish market. I think one of your speakers has mentioned that it's a bullish market. Bitcoin is at records, has been trading at records, gold, strong manufacturing data. So I think it's a combination of all that, and nobody really knows where it's going to go. Now we've been talking about it since October, the risk of a wider conflagration in the Middle East, but I think it's becoming a bit more real now, how Iran will respond. We're still seeing flows of weapons or promises of more weapons by the United States to Israel. So, I don't see this ending anytime soon. So I think the geopolitical risk is now sort of firmly ingrained in the market.
Matthew Wright, senior freight analyst at Kepler. Matthew, what can you tell us about, the stress, obviously, that came into shipping with the disruption in the Red Sea, but not only the Red Sea and the Suez Canal, but also the Panama Canal continues to be a stress point in terms of drought impacting its ability to sort of facilitate the capacity there. The Red Sea, of course, with the armed conflict with the Houthis in Yemen. But the collection of that, is that stress now, has it been absorbed into the general market flow? We're seeing in middle distillates and so forth that we're back to rhythm. It's just taking a little longer. Or is there still stress and upward motion into the oil price from shipping, do you think?
Yeah, good morning, Sean, and thanks for having me on. It's definitely a factor, and I think, as Kate said, there's a number of factors that are combining. I think the recent strength in the oil price is more to do with those factors that Kate mentioned, but the fact that we've had the Red Sea for now a number of months has sort of baked in a level of risk that is just going to persist. Same with the Panama Canal. We have had an increase in transits at the Panama Canal, but over the next 2 months, we're now going to be reaching the low water level seasonally in the Gatan Lake. So that will continue to restrict transit to the Panama Canal. Now, that's not a huge issue for crude oil, but it is particularly for middle distillates from the US Gulf down to the west coast of South America. So definitely a factor there. We've just got, one of the other things that I think is important around the oil price is Mexican crude. Mexican crude exports are sort of being held back because we've got this Dos Bocas refinery starting up later the year. That's a massive impact. These are the heavy sours, really, really valuable crudes to the market at the moment. So that, combined with all of those factors you've got going on in the Middle East, is really sort of setting an upward tone. But from a shipping point of view, I would say those main factors are now plateauing at a steady level. It's not getting easier to ship through the Red Sea, but it's definitely not getting harder as well.
Dr. Ilya Buchev, managing partner at Penthalon Investments and also a senior research associate with the Oxford Institute for Energy Studies. Ilya, I'd like to kick off with getting your thoughts from the OPEC Plus in Vienna, because they're meeting today virtually. It's their every 2-month meeting, and you've just come back from a workshop with OPEC in Vienna. I just want to get any sense from the ground there about their thoughts, the thinking in Vienna headquarters about these oil markets?
Thanks, Sean, for having me on. Yeah, I would say that OPEC is doing a marvelous job in managing the market, both on the physical side, but also on the financial one. I was very surprised spending a day in Vienna how much efforts they put in understanding the flows in the market, because I agree with the panelists, there are a lot of factors currently driving the price of oil, but at the end, factors don't buy or sell. It's the people or computers buy or sell. And this is what OPEC is trying to understand. For example, we spent a lot of time debating last fall, if you remember, oil prices fell, even though OPEC was cutting production back then. So OPEC was cutting 1 or 2 million barrels a day of physical oil, but at the same time, hedge funds sold roughly 200 million barrels in a month, which basically adds up to 7 million barrels a day. So obviously 7 is bigger than 2. And back then, prices went down. The big question is, what's going to happen when the hedge funds are going to buy it back? And this is really what we have been seeing in March, more like the reverse effect of that selling that occurred in October and November.
Before we get into the sort of granular end of the paper market, just staying with the physical market in terms of the OPEC thinking, obviously they're meeting today, no change is expected. But do you think is there emerging that anything you heard in Vienna that OPEC Plus may start to think that they can unravel some of these deep cuts? I mean, they're currently carrying over 6 million barrels of oil supply cuts, all total together. Any consideration, any mutterings from Vienna that you heard that they might be able to start to unwind those cuts?
Obviously, they didn't. I mean, I didn't hear anything specific, but my opinion is don't fix what's not broken. Why bother now? They are clearly winning both on the physical side and on the fundamental side. The inventories are not building for sure. The mission is more or less accomplished. The price is going up. The big question is how and when are they going to exit? And my opinion on that, they want to sell or exit into the strengths. So currently, more or less, what they have accomplished, the financial markets bought the futures back, bought the shorts back, but the markets are not overpriced by any means. So if they somehow force financial markets to continue to buy and oil price is going to rally towards 100, then it would be more natural for them to start exiting the cuts. But I don't see it's happening right now. I think we're talking more about summer when demand picks up, maybe closer to June, July time of framework.
I suppose, Kate, that then comes back to the sort of the first question from an OPEC Plus perspective. What's driving this oil price, right? Is it tightness in the market? Is it the supply cuts, or is it more the geopolitical rally? Because all have kind of come at the same time to sort of fudge each other out, cloud the picture a bit, because obviously we go into the sort of elevated demand quarter with the second quarter US driving season and so forth. So you'd expect tightness to come, but then you also have the geopoliticals heating up at the same time. From OPEC Plus point of view, what do you think they're going to be driven by?
I think they are keeping a tight lid on markets, and I think you're going to see more effort to sort of force compliance by those countries that aren't complying fully with their quotas. But don't forget, they've got this new system that's coming up where they're going to have an independent assessment of capacity. That might cause some problems because some people will get lower quotas. But I think one of the other important issues to look at is the market structure at the moment is in their favor. And I think the way that if they decide to sort of taper those cuts gradually, whether they do it over 3 months, whether they extend it for another 3 months while they see how the market's going, because they don't just look at price, they look at stock levels, they look at, markets. And if you look at the backwardation in the market, it's not very, it's quite narrow in the first few months after, I think we're trading June at the moment. But it gets a bit steeper as you go into the final quarter. So I think that's one of, and don't forget that if it depends on whose demand outlook you're looking at, right? If you're looking at OPEC, it's 2.23 million barrels per day growth. If you look at IEA, it's 1.3. But the
IEA, I suppose
plus,
it is to. The IEA has incrementally risen its
slightly.
demand.
It's a very slight, yeah.
I know, but it's continuous over 4 months, every month. So you would expect that continues, that gap between the two starts to narrow.
Yeah, but the other issue is you're going to have 1.6 million barrels a day of increases from the non-OPEC plus countries, led by the US, which some people think is going to go up, even more to a new record this year. So, how much longer will OPEC plus, Saudi Arabia, Russia, which has never really been very happy receiving market share to the United States, how much longer will they sort of sacrifice market share for price? I think that's one of the issues that's really important, because as things stand, whether you're looking at 2.23 million or 1.6 or 1.3 million barrels per day of increase, non-OPEC is going to be non-OPEC plus are going to be increasing by 1.6 collectively. So that really kind of covers your demand increase. So I think it's going to be quite a difficult balancing act. But I do agree that OPEC plus have been pretty good at managing the market. It's going their way. So, they must be doing something right.
Well, we're just showing on the screen there the survey question we asked a few weeks ago in early March, that we had forecast that prices would get to 90 by the end of Q1. We might have been off by a few days. But Matt, one of the things that seems to be also underpinning this recovery, or this move to another level, if you want, has been that China isn't as bad as the headlines in the first quarter were kind of indicating. Pre-China New Year, there was a lot of bearish narrative around China's recovery. But generally, it looks like it's obviously not stellar, but it's clearly not in the doghouse. What are we seeing from a shipping point of view coming around China? Any of the flows that give us some kind of an indication as to the health of the Chinese economy?
Yeah, very good question. And I think you're absolutely right. I think, yes, there's still some real issues in the property sector, but they've really invested into manufacturing and to industry, which are actually sort of greater use, have a great use of oil products. So, we're heading into Chinese peak refinery maintenance season over the spring, and actually crude exports to China haven't declined as much as you would perhaps have seen in other years. And part of the reason for this is Chinese onshore crude stocks are actually very low. They drew down a lot over the first 3 months of this year. So there's good reason to suspect that crude flows to China over this whole maintenance period will be pretty steady, between sort of 9 to 10 million barrels a day, which is 100% going to support the market. That is a very important outflow from the Middle East in particular. I think we've got to take into account that we now have all of Saudi Arabia's refineries back online after a lot of maintenance after the last couple of months. But what's interesting there as well is we're not actually seeing a big decline in crude exports from Saudi Arabia, suggesting that there was actually some capacity to maintain exports, or while they were during maintenance, they were sort of able to sort of keep exports at a high level, and now those refineries back, they're just maintaining it. So from a freight point of view, it means we're likely not going to see crude coming as much crude coming all the way from the Atlantic basin, which would really drive rates higher, particularly from Brazil, etc. But China's definitely forming a part. Just what's another interesting factor around the balance is we're sort of heading to a period of throughout the year where this is actually the longest the balance is going to be potentially. There's more surplus crude in the market, so it's interesting that we're sort of touching on $90 a barrel at this point in time. And as we've said, this is pretty much just due to those geopolitical events that are sort of dotted around the world. We're going to be heading to a tighter market end of the year. So in terms of OPEC's thinking, I think, well, our view in Kepler is while we are going to be heading, we have higher crude prices and we're going to head into a tighter market, a lot of that is not necessarily due to OPEC barrels. A lot of that is more due to non-OPEC. However, so our view at the moment is OPEC is really going to keep these cuts through the end of the year. However, we're going to start to see a slowdown in US production. We're going to see maintenance around a number of fields in Norway and the US that will start to shift the narrative towards a requirement, a net short in OPEC barrels. And that's when we're going to start to see OPEC start to maybe open the taps a little bit more.
Ilya, I wanted to get your thoughts on, you had started to mention it there, the impact from the fund managers, from the paper money. We've seen that a big increase in the first quarter of fund managers moving into both crude and products, and quite bullish positions on diesel are now being unwound because of the profit taking. Your thoughts on the impact of the fund money coming into the paper markets and its role and where that's likely to go?
Yeah, we have been quite constructive oil for the past 3 months, pretty much in anticipation of this short covering that has been happening over the last 2 months. Because the way how the hedge funds work, they are very heavy oriented towards momentum, and simply the passage of time ruins that momentum. So the funds were betting on the short side for different reasons, and then simply if you sit there and the prices don't collapse for a period of time, they have to cover. So purely, it's just the passage of time that's going to force hedge funds to cover. And that's what has been happening. They more or less covered their short position. And that was one of the reasons why the geopolitical risk premium wasn't seen in the market. So the hedge funds, we can think about them being smart people, but they're very bad in modeling geopolitical risk premium, simply because there was not enough precedents in the history for them to train their computer models. There were just not enough, fortunately, wars or any other episodes that materialize. So they simply missed that geopolitical premium back and fall. And now, once their position is covered, now we are basically seeing this geopolitical premium fully reflected in prices. What I claim today is the price is fair. Geopolitical premium is finally visible because it used to be suppressed by hedge funds, but not anymore. They cover their position. We all see it. Oil by no means is overpriced. The price is fully reflected the current fundamental state of the world. Everything I view at this point is fair. So what's going to happen in the future? Obviously, as you know, Sean, predictions are hard, especially about the future. So, and that's what I think OPEC is trying to do. But more or less, the financial flows are somewhat neutral now. They covered the shorts, but they're not really long yet. So I think OPEC wants to be seen as in a complete command of the market. So they actually don't mind the hedge fund community now start leaning more on the long side, and then they're gonna come in effectively and be seen as a savior for the market when the price is already closer to 100, and start gradually tapering their cuts. So I do think there is more to buy, and I do think that funds are going to start switching towards the long side. Again, for many different reasons. You see what's going on in the world. I mean, Bitcoin is going crazy, gold is going crazy, oil is very cheap if you measure it in gold or if you measure it in Bitcoin. Just like from that perspective, everything is expensive, and allocating more money to oil honestly makes a lot of sense.
Let's go to the survey question that I started out our conversation with this morning, which is the main driver. What is the main driver for oil prices to $90 a barrel? inevitably it's kind of all of the above, one might say. And I think it's all of the above that kept us in the 78 to 82 Brent price for most of the first quarter. But what is the main driver pushing it out of that range and up to $90? Is it the OPEC supply cuts and the discipline there and the scale of them and the kind of reconfirmation that they were going to be rolled into the second quarter? We got that news early in March, and it was kind of around that same time the prices started to move. Similarly, the geopolitical wars started to heat. I mean, how hot can they be? They're nasty as ever, but U.S.-China demand, the U.S. economy doing better than had been, maybe they've spent a lot of last year with the kind of recession is coming, and it never came. And China had the same kind of narrative that was finally lifted and started to say, well, actually, China has a heartbeat. Or is it the seasonality that's just typical every second quarter with the expectation of the summer driving season in the US that prices just naturally rise, demand rises? So which are the main drivers for oil prices? A, to break out of where we were and move towards 90. That's ultimately the question. Which of these is the trigger? Kate, in the news headlines today, we have the driver, one of the elements of the API weekly inventory numbers looking a little bit tighter this week than last, but also the news that the US government is backing away from any commitments made only recently at CERAWeek that they would be rebuilding strategic SPR inventories. They are not. Where do you think the basic sort of the old-fashioned fundamentals of inventory play a role here in keeping this oil market elevated?
I think they do a lot, but you mentioned the United States, and if you look at who's the drivers of the OPEC Plus, it's Saudi Arabia and Russia. You've got the US election coming up, and I mean that's not very far away, and high oil prices are. I don't think they're going to taper the cuts, because I have a feeling that from sort of what we've seen so far since Trump's election the first time around, that both would like to see a Republican win. So I think that's that it is a factor that has to be taken into consideration. And I think, yes, there hasn't been any supply disruption per se, and prices might have been higher, but you mentioned that 6 million barrel a day cut, which is sort of roughly equal to spare production capacity, most of which is held by Saudi Arabia. So I think that political considerations with the US election coming up, I think will also have a hand to. I mean, they will deny that politics has anything to do with it, that they're not, going to try to influence the election. But it's hard to imagine that they're going to want to bring prices down, which would help Biden and the Democrats as opposed to the Republicans. So I think that's something that. But yes, stock levels, they always like to see them not at the
Well, we saw 2 years ago
below the 5-year average.
The midterm elections, we did see the administration, the Biden administration, sort of use that to help ease the pricing at that summer be going into that election. Will they do the same if prices start going up? I suppose they might look at that. Matthew, I wanted to take the opportunity of having you here, as I'm scratching my head a little bit around it. The terrible tragedy of the collapsed bridge in Baltimore. Your thoughts, is this a big deal for shipping? Obviously, it's a big deal for bridges in Baltimore, but what are the dominoes from this event, or are there any that we should be paying attention to?
Yeah, the main thing from a commodities point of view is on the coal side. So it's just having a look at the numbers. So last year exported around 24 million tons of coal. So this made it the 17th largest coal port globally. So it is relatively significant. It's particularly on the north, from a US point of view, it is significant. The fact that we've got a number of vessels stuck on that side, and the fact that there is, that it isn't a case of there's been disruption and that will ease. That port is going to be sort of blocked now for us until the salvage efforts are resolved. So it is significant from that point of view. I would say There are other places, there are other, it's the 17th largest, not in the top 10. So, take that with a pinch of salt. And then again, from the containers and a ro-ro, and there's a lot of industrial machinery that is produced and shipped out of the area. So yeah, there's going to be a knock-on effect for all of those things, but I don't think it's going to be critical, say, to the coal market particularly.
I can't remember ever anything like this happening before. How strange is it that a ship of this scale would lose its navigation capabilities and obviously run into anything, never mind knock a bridge over? But what's the story of the actual technical error here of whatever it might be?
Yeah, it's a good question. I think at the moment we don't really know. I would
I
agree.
mean, if this was an airplane, they'd be calling back every version of the same plane, right? That we had the whatever crash recently, or when the door blew out of that plane in the Boeing, and I mean the CEO was fired. I mean the company looked like it was nearly going to implode.
Yeah.
There's no version of that here.
No, absolutely. And fundamentally, the redundancy in vessels is just not the same as in aircraft. And whether it should be or shouldn't is sort of another argument. I think the investigation will be really interesting because it will highlight a little bit more about how it happened, why it happened, and why if there was lost power, it wasn't rebooted from another source immediately, and there like I said, there's not enough redundancy in the system, particularly operating around port areas. That's incredibly dangerous. I mean, as it happened, it's one of the worst possible outcomes that could have occurred. I wouldn't be surprised if these things happen, but they happen in open water and that they're resolved, and nobody necessarily would ever know about it. But yeah,
Right.
it'll be very important to see the outcome of the investigation here.
Yeah, that would be a fun investigation to be on. Ilya, last word to you there. Do we care about the outlook for Fed rates? It seems to every day come to the front and center. All of this elevation, you mentioned it, Bitcoin, gold, everything's going up. Everything is in some element of inflationary, or certainly being inflated, whether it translates into actual technical inflation or not. The Fed seems to be caught between a rock and a hard place here, the ability to cut rates. But do we care in the oil markets?
I would say, honestly, very little, and some people may disagree with me. There are so many factors that drive in oil to macro relationship, and those factors continue to change. So on one hand, for example, yes, we do concern about inflation. The manufacturing data both from China and US were pretty good. So the inflationary pressure could be back up, which means that rates can stay for longer. So there will be some demand for oil as inflation hedge. So that's clearly a bullish factor. But on the other hand, if interest rates going higher, that means dollar is going higher. But if dollar is going higher, that's not good for oil because the demand in China can start suffering. So you see, even in this simple example, I can clearly see one bullish factor, it's inflation, but one bearish factor is dollar. Which one of them is going to dominate? It's a tough call. I think there is just people spending a bit too much talking about the impact. I think they should look elsewhere.
Well, we had U.S. first quarter auto sales grow by nearly 5% despite 5% interest rates. So it's hard to see where the Fed finds a window to cut into a fairly vibrant economic outlook in the U.S. economy. But the one driver, as mentioned by another one of our commentators regularly, Omar, is the fact that they're not looking at inflation or not, or unemployment, where it seems to be both in very healthy places. They're looking at the cost of paying the U.S. debt, and that's the driver, will be the driver. Anyway, we have to leave it there. It's 11 o'clock. Brent crude oil is trading at $90 a barrel, or sorry, not 90 yet, but $89 a barrel on Brent. Pretty, if you're selling the stuff, at least from a producer point of view, a pretty healthy space. Whether it has knock-on effects for inflation and other challenges, we'll have to wait and see. But it does feel like all of the momentum, or certainly all of the factors, are an upward pressure. It's hard to identify anything that would be bearish. The main driver, according to votes in this room, is geopolitical and wars. The breakout to 90 by a big majority in this room. We'll put that on social and see if the rest of the world agrees. Kate Durian in Dubai, thank you so much. Matt Wright, nice to have you back at the table. And Ilya Buchev, thank you so much for joining us this morning. We have Halftime Talk interview with the CEO of Duqm Port, Reggie Vermeulen, who gives us some insights from that side of the world. Thanks, everybody. Have a great day. All the best.
Thank you, Sean.
Bye.
Cheers, take care.